I want to welcome on today's guest, Mish Schneider. Mish has been a frequent guest on the show. It's always a pleasure. She's the chief strategist at Market Gauge, coming to us from beautiful Santa Fe, New Mexico. Mish, good to see you. How are you?
Just great. It's August, though, and generally great time to go away. And I think the market is kind of reinforcing that feeling.
It feels like buyers are going away for now, right? On days like today, we see the rotation lower. I'd love to sort of get your take on where we're at. We had the CPI data this morning. Initial rally, things are rotating lower. We're starting with your chart of the bond markets. Interest rates have been moving higher. Is there more to come there? What's your take?
Well, interesting listening to you before I came on. It's basically chart school. A couple of things you talked about that were really relevant to this chart. One is gaps. So you can see all the gaps that we've had down since we broke those lows there at around 100, let's call it. And it's been straight gaps down without any kind of recovery until we reached the trough and we started to come back a little bit. But so there was some buying coming in. However, the other thing you talked about in your chart school sort of way is that there was an area of resistance that had to clear in order for that to be very convincing. And it was right around 97.35 to 40. And even today, it looked like it might challenge it after the CPI numbers came out. And of course, instead it reversed. And that is no surprise really to me in particular, because I'm looking at the fact that it's been underperforming the SPY for quite some time. And we're going to get back to that point in a moment. And if you look at the momentum down below, which is our other ACP plugin, it's broken down pretty much under everything with almost a chance of a mean reversion. But we know almost surviving an operation doesn't necessarily mean anything. So I think what we can do with the TLTs is assume a couple of things. Number one is, and I'm on X a lot, so I see the various points of view with CPI, which also relates to the bonds. There's a huge number of people who believe that the Fed is done raising the rates and the bonds have bottomed, and it's just a matter of time that they're going to not only announce a pause, but eventually pivot. And in that camp, people also believe that soft landing and that inflation has peaked. So the CPI today is a lagging indicator. And I think that's what the market told you. And that's what the bonds have told you, is that clearly it was a decline over the several months. But today we saw areas of inflation starting to pick up again with reasons that we can believe, particularly in oil and energy, that it may not be done. And so there's the other camp, right, that says, oh, the Fed is going to raise a couple more times and we're going to have higher yields for much longer because the Fed is really only focused on fighting inflation, and today's numbers are not going to give them any reason at all to pause. So I say in these camps, you can go nuts looking at them, or you can look at the chart, and this is pretty clear right now. We take out those most recent lows, there will definitely be more pain.
I love that way of summarizing it, right? We could debate whether the bull-bear debate endlessly, but at the end of the day, why not just look at the chart and see what it's telling? I think with both stocks and bonds, you certainly saw that initial move today, but then by the end, sort of had a very different feel to it. You know, lower bond prices, higher yields certainly tends to have implications for growth. Talk to us about the QQQ. How does that inform your analysis of this chart?
Well, before I get into that, I just want to make one other point about bonds, because there is some silver lining. And that is that we use our risk gauges based a lot on what the performance is on the SPY versus the long bonds, on the junk bonds versus the long bonds. And as long as, even with the SPY falling, the bonds are falling harder, or the TLTs are falling harder, or the junk bonds are holding up against the long bonds, we can still, or the gold is falling against the SPY, we can say those three things are still right now, just to confuse us even more, saying risk on remains in the market. We have not seen signals of risk off yet. That leads us right into Nasdaq.
Yeah, that's a good point. And I think the stock to bond ratio is certainly reflecting what you just said, still kind of favoring stocks regardless here.
I'm sorry, if the TLT started to rally from here, I think I would get more concerned about recession than what you would read out there, that people are concerned about it. So there you go.
Got it. Okay. Yeah. Good point. Talk to us about the QQQ. Now testing, the 50-day moving average. Where are we at here? Where are we headed, do you think?
Well, now we added something new to the chart, and this is going to be launched on stock charts very soon. And I have been writing a lot about the July 6-month calendar range. So very quickly, we look at the calendar ranges 2 times a year, January and July. So I call this the second half of the year. And it's important because when we're looking at the Nasdaq right now, we had a couple of days where it cleared it right in the early part of July. But yet we have been underneath it with a gap, by the way, and we've not really been able to get back above it. So that tells me right now that not only are we seeing this as a correction, but it is possible, based on a few other indicators, that growth is kind of done. Does that mean we're going to crash and burn? No. But we would be looking now not only at the 50-day moving average, which it's sitting on as it's closed yesterday and even today, as the first, as you call it, line in the sand. But we'd also be looking at around 362, which is the 6-month calendar range low. And the reason why I'm so keen on these ranges right now, as we're in August particular, and even though low volume and obviously a lot of speculators gone for the summer, is that in January, just the opposite happened with Nasdaq and with SPY. It set up the 6-month calendar range in January. The Nasdaq took it out and never looked back, really, except for even the correction that we had in March. It did not break down under that January 6-month high. So now, if we break down under the 6-month calendar range low, I think that, along what we just said about bonds and how that impacts growth, would mean some trouble. But the evidence is still, the jury's still out, just exactly what you said. We don't really know yet. Now, in terms of the performance, it is underperforming SPY. And in terms of momentum, and here's where things could get better. It's sitting right on the Bollinger Band. That's sometimes ripe for a mean reversion. So if tomorrow we hold the 50, we start to see a little bit of an increase in momentum as we end the week. Again, it's possible that this was the correction, but I'm not going to say that one way or another. We really don't know yet. And if I had to make a guess, I would think lower, but that would be just a guess until the evidence is there.
Right. No, that's a really interesting take, and thanks for highlighting the new indicator. I know we're working up for ACP from Market Gauge. So if stocks, particularly growth stocks, starting to not work, bonds aren't working, they're going lower. What is working? China, perhaps. Let's talk through the FXI, where there may be an opportunity here.
Well, it's interesting. I haven't traded anything about China in quite some time. And so what really came to it, the barons for me, is, again, the chatter on X and the experts and the analysts, some very bearish in China. It's over. It's going into major recession. They've lost control. The jobless rates on the youth are really high. The exports and imports, we know, just went down. They can't live without the United States. And yet, once again, the price looks very different. We had Alibaba came back with 14% growth in their sales, unexpected. And we know that China can print money all day long because, first of all, President Xi can pretty much make any decision that he wants, number one. And number two is they're not having the type of inflation that we're having here. And the two areas really where they went down, believe it or not, in their inflation numbers, in terms of disinflation that people have been calling, was pork and transportation. So not really going to be an impact globally. But anyway, getting back to the chart. Just like we saw the 6-month calendar range high and low on Qs, we have it here in the FXI. And forgive me for my not so great drawing here. It may not be perfectly horizontal, which is why we can't wait for you guys to have the plug-in. But it flew for a minute there when they were doing some quantitative easing, and it looked like they were going to come in and add a lot of liquidity to the system, and then it came off. And that's why it's a line. It's not necessarily the only line. But when it did correct, look at that. It corrected right to the 200-day moving average. And now it's back sitting right on the 6-month calendar range high. So that's one thing. If it gets through this 29 level here, you might have a very low risk situation buy. And particularly if it can get back through today's high in that 10-day moving average, then I think you might have a reason to think, perhaps China versus the US is an interesting play, particularly as we move down a little bit to the leadership ACP plugin, you can see we're outperforming a little bit now on the SPY. And if you look at the momentum indicator, even though we did have a mean reversion sell signal, look how nice that was compared to the peak high that we had earlier in the month, in July that is. Now we are actually holding on to the 0 line and the 50-day moving average, which, by the way, is a bullish divergence to price because the 50 is over the 200, where in the price, the 50 you can see there is still under the 200, looking like maybe it's getting ready for a golden cross. So I just wanted to point it out for two reasons. One is technically it may be interesting, and two is these lagging indicators and a lot of these analysts, especially this year, who are not looking at price but crunching numbers, have not necessarily been the best people to follow for making your investment decisions.
Mish, there's so many little great nuggets of technical analysis wisdom in there. And I love that discussion about what could happen at the end of the day. Why not focus on the charts and some clear examples of what's starting to work, what's starting to not work, and some levels to pay attention to. Mish, always a pleasure. Thanks for sharing some charts with us. Be well, stay safe there in Santa Fe. We'll talk to you again soon.
Thank you so much, David.
That's Mish Schneider. Mish is the chief strategist at Market Gauge, coming to us from Santa Fe, New Mexico. We mentioned some of the ACP plugins that we have from Market Gauge, some really interesting proprietary indicators too that we have already. A third one that we're working on just now, looking at the 6-month range and 1-month range. So look for that very soon on our ACP platform. And it's so interesting. What I love about charting, as Mish was saying, is something like China, whether or not you think it should work, whether or not we could debate why things are going up or going down, at the end of the day, is the chart going up? That should be the most important question you should be trying to answer. And that is what hopefully the Stock Charts platform, including ACP, can help you do. Great take there, as always, from Mish Schneider at Market.